Imagine growing your wealth without checking the market every day or stressing over which stock to pick. No complicated strategies. No need to be a financial expert. Just one simple investment that works quietly in the background and builds your future. This strategy has helped millions of everyday people build long-term wealth without burnout. You don't need a lot of money to begin. You just need the right mindset. And if you stay with me till the end, I'll share a bonus tip that most beginners completely overlook. It might be the missing piece that helps you stay consistent and actually feel wealthy. Welcome to FinTech Innovate AI, where personal finance becomes simple so you can save better, invest smarter, and live the life you deserve. 1. What is an index fund? An index fund is a type of investment that follows, or tracks, the performance of a specific group of companies called an index. Instead of trying to beat the market by picking winning stocks, it simply copies the whole market or a part of it. This means when the market goes up, your money grows with it, and when it dips, your investment adjusts too. For example, an S&P 500 index fund invests in the top 500 largest companies in the United States. A NASDAQ 100 index fund follows 100 of the biggest non-financial tech companies like Apple, Amazon, and Microsoft. There's also the Dow Jones Industrial Average Index Fund, which includes 30 major companies such as Coca-Cola, McDonald's, and Boeing. The goal of an index fund is not to beat the market. It is to match it. This approach makes it simple, steady, and beginner-friendly. That's why when people search for what is an index fund, they're really asking how to grow wealth without gambling on stocks. And that's exactly what index funds help you do. 2. How do index funds actually work? Index funds work by pooling money from thousands of investors into a single fund. That fund then invests in all the companies that make up a specific index, like the S&P 500 or the NASDAQ 100. So instead of buying one or two stocks, your money is instantly spread across hundreds of companies. This is called diversification, and it helps lower your risk while keeping your investment stable. When the companies in the index grow, the value of the fund grows too. If they drop, the fund adjusts naturally. You don't have to research every company or follow the market daily. That's the beauty of passive investing. Unlike active investing, where fund managers constantly buy and sell stocks trying to beat the market, index funds simply mirror the market. This passive approach keeps fees low and removes the stress of trying to guess what stock will win next. So if you've ever wondered how index funds work, this is it. They're built to match the market's long-term growth with minimal effort from you. And that's exactly why passive investing, explained in simple terms, leads us back to index funds every time. 3. Index funds versus mutual funds. What's the difference? Many people get confused between index funds and mutual funds. They sound similar, but they work differently. Let's break it down clearly so you understand what sets them apart. A mutual fund is actively managed. That means a fund manager chooses which stocks or bonds to buy and sell, trying to beat the market. Because of this hands-on approach, mutual funds usually charge higher fees, and not all of them perform better than the market. On the other hand, an index fund is passively managed. It doesn't try to beat the market. Instead, it follows an index like the S&P 500. There's no constant buying and selling, which keeps fees much lower than mutual funds. Index funds are simpler, cheaper, and often more reliable for long-term growth. Mutual funds may have the chance to outperform the market, but they also carry more cost and risk. If you're just starting out, Understanding the difference between index fund and mutual fund can help you choose the right investment path with confidence. 4. Why index funds matter for long-term wealth. If you want to build wealth that lasts, index funds are one of the smartest tools you can use. They offer a combination of low fees, built-in diversification, and long-term growth that's hard to beat. Because index funds track the market instead of trying to beat it, there's no need to constantly buy and sell stocks. This means they charge much lower fees compared to actively managed funds. And when you're investing for years or decades, even small savings on fees can add up to thousands of dollars. Index funds also spread your money across many companies at once. This built-in diversification lowers your risk. If one company struggles, the rest of the fund helps balance it out. That's a key reason why index funds are good for beginners and long-term investors alike. And here's something powerful. The longer you stay invested, the better your results. Index funds reward time in the market, not timing the market. Even small, consistent investments can grow into serious wealth if you let compound growth work its magic over the years. So when people ask why index funds are good, the answer is simple. They give you peace of mind, steady returns, and a low-stress way to build your future. 5. Who should consider investing in index funds? Index funds are one of the best investments for beginners. They're also perfect for anyone who wants to grow their money without spending hours studying the stock market. If you're just starting your financial journey, index funds give you a simple way to invest with confidence. You don't need to be a financial expert. You just need to be consistent. Even if you can only invest a small amount each month, that's enough to get started. They also work well for busy professionals who want their money to grow quietly in the background. No stress, no constant decision-making. Just set it up once, automate your contributions, and let time do the heavy lifting. More than anything, index funds offer peace of mind. You're not betting on one company. You're spreading your money across many, lowering your risk and building wealth slowly but steadily. So if you're wondering where to begin and you want something that's safe, simple, and proven over time, index funds are one of the best investments for beginners and long-term thinkers alike. 6. How to start investing in index funds. Getting started with index funds is much easier than most people think. You don't need a finance degree or a large amount of money to begin. You just need to follow a few simple steps and stay consistent over time. Step 1 is to open a brokerage account. You can use well-known platforms like Vanguard, Fidelity, or Charles Schwab. These companies offer trusted services, low fees, and easy access to index funds. Setting up an account usually takes less than 20 minutes online. Step 2 is to choose the index fund that matches your goals. For beginners, the S&P 500 Index Fund is a great starting point because it includes 500 of the largest companies in the U.S. Other solid options include Total Market Index Funds or NASDAQ 100 Index Funds. Look for funds with low expense ratios to keep more of your returns. Step 3 is to automate your contributions. This means setting up a regular deposit, like weekly or monthly, from your bank account into your investment account. Even if you start with just $50 a month, the consistency builds powerful momentum. This habit takes the emotion out of investing and builds wealth in the background. So if you're searching for how to invest in index funds, this is your roadmap. Choose a reliable platform, pick a strong index fund, and automate your contributions. These simple steps can help you build long-term wealth without stress or confusion. 7. Common mistakes to avoid with index funds. Index funds are simple, but that doesn't mean they're mistake-proof. Beginners often make small errors that can hurt their progress over time. Avoiding these mistakes can help you grow your money with less stress and more confidence. One big mistake is trying to time the market. Many people wait for the perfect time to invest or pull money out during a dip. But timing the market is nearly impossible. It's better to stay invested and let time work in your favor. Another common error is ignoring fees and expense ratios. Even though index funds are known for being low cost, not all of them are equal. Make sure to check the fund's expense ratio. A difference of just 0.5% in fees can cost you thousands over the long run. The third mistake is not staying consistent. Investing only once and forgetting about it won't get you very far. The real power comes from regular contributions, even in small amounts. It's the habit, not the amount, that builds wealth over time. So if you're starting your journey, keep these beginner investing errors in mind. Avoiding these index fund mistakes can make your path smoother and your future more secure. 8. Bonus tip: the power of set it and forget it. Here's the truth. Most investors learn the hard way. Success doesn't come from timing the market. It comes from showing up consistently and letting time do the heavy lifting. The most powerful habit you can build is automating your investments. Choose your index fund, set up automatic deposits, and then stop overthinking. This strategy is often called set it and forget it investing, and it works because it removes emotion, stress, and decision fatigue. When markets drop, you keep investing. When markets rise, you still invest. This steady rhythm keeps you moving forward while others panic or hesitate. Over the years, this habit compounds into real wealth. And here's the real secret. This discipline is what separates those who reach financial freedom from those who just chase it. It's not luck. It's not timing. It's long-term consistency, done automatically. So if you remember one thing from this video, let it be this. Don't just plan to invest. Automate it and let your money grow while you focus on living your life. Index funds are simple, affordable, and powerful for building wealth over the long run. You don't need to be a financial expert or start with a lot of money. You just need the right information, a clear plan, and the consistency to stick with it. If you've been overwhelmed by investing or didn't know where to begin, index funds are a great first step. They take the guesswork out and let your money grow quietly behind the scenes. If you're finding this helpful, make sure to like, share, and subscribe. We break down personal finance in a way that's simple, real, and actually useful. Thanks for watching.